As an investor, you're always asking yourself a couple of key questions. Is the stock price I'm seeing today actually fair? And maybe more importantly, how do I look past all the old charts and news to figure out where a company is actually going? It's really the difference between trying to drive by looking in the rearview mirror versus keeping your eyes on the road ahead. And this slide really breaks down those two ways of thinking. On the left, you've got the old school historical analysis. That's the rearview mirror. It tells you if the PE ratio is higher or lower than it used to be. Useful, sure, but it's all about the past. Now on the right, that's the forward-looking approach. This is like your car's dashboard, using your own assumptions about the future to figure out what kind of returns you might actually expect from here. And that's really the million-dollar question, isn't it? How do we build that forward-looking dashboard with some real confidence? Well, that's exactly what we're going to dig into today. We're going to break down how the Finmagine Scenario Valuation Calculator is designed to help you do just that. Okay, first things first. Before you can even begin to form your own opinion on a stock, you absolutely have to understand what the market is already thinking. So the first question any smart investor should ask is this: what level of growth is already baked into today's stock price? This is where a pretty cool technique called a Reverse DCF comes into play. It kind of flips the whole valuation problem on its head. See, instead of you trying to guess a growth rate to figure out a fair price, it does the opposite. It takes today's actual price and tells you, hey, for this price to make any sense, the market is betting that the company will grow its profits by this much. It's like finding the market's secret expectation price tag. So here it is in action. For a company like Affle India, the tool shows that the current stock price implies about a 9.8% annual profit growth. And just like that, your job as an investor gets a whole lot simpler. The question isn't some vague, what is the stock worth anymore? Now it's a much sharper question. Do I believe Affle can grow its profits faster than 9.8% a year? It's a fantastic, immediate sanity check. But, of course, that leads to the very next logical question. Okay, we've got a number, 9.8%. But is that a high bar, a low bar? How do we even begin to put a number like that into context? Well, this simple framework is a huge help. If you see a growth rate under 5%, that tells you the market is pretty pessimistic. It's a low hurdle for the company to clear. Now that 5 to 12% range, where our Affle India example falls, that's pretty moderate, feels reasonable. But once you start creeping up past 12%, and especially over 20%, you are in what I'd call priced for perfection territory. The market is expecting greatness, and any little slip-up could be a problem. All right, so now we have a solid idea of what the market thinks. It's time to take the next step and answer that second crucial question. Okay, what if my analysis is right? If my assumptions play out, what kind of returns should I expect? What's great is that the calculator shows you all the math right there. There are no black boxes. First, it projects the future profit using whatever growth rate you plug in. Second, it figures out a future market cap by applying what's called an exit multiple, like a PE ratio. Third, it just divides that by the number of shares to get a target price. And finally, and this is the important part, it calculates your potential annualized return, or CAGR. It's a simple, transparent, four-step process. Now, here's a really important detail. Where do those numbers come from? A lot of generic calculators out there will just slap a standard PE like 40 on every single company. That doesn't make much sense. This tool, on the other hand, seeds its base scenario with the company's actual 5-year median PE. It means your starting point is grounded in that company's specific history, which is a much more realistic way to start. That is a very fair question. We've been talking a lot about price-to-earnings ratios, but that's not always the right tool for the job. What about companies where earnings just don't tell the whole story? I'm thinking of industries with massive upfront costs or a ton of debt. And this is exactly why the calculator has two different valuation models. The earnings model, using PE, is fantastic for asset-light businesses like IT or consumer goods. But for those capital-heavy sectors, think metals, infrastructure, telecom, huge depreciation costs can really mess with the net profit number. So for those, you switch over to the OPM tab, which uses a metric called EV/EBITDA, to give you a much cleaner view of the business's actual performance. Here is a perfect example. Lam Research is in the semiconductor industry, very capital-intensive. Using the OPM tab gives us a clearer picture because it starts with something called enterprise value, which includes the company's debt. From there, it works backward, it subtracts the debt, adds back the cash, and then gets to the value that's left for us, the equity shareholders. This is so important because it properly accounts for the company's debt, something a simple PE ratio completely ignores. So let's recap. We've got the tools, a reverse DCF to see what the market is thinking, and two different tabs to build our own scenarios. So how do we actually put all this together and start analyzing some real stocks? Okay, here's our first use case. Just a quick check on a high-quality company. You pull up a solid compounder like Polycab, and you can instantly see the base scenario projects an 18% annualized return. And right away you can ask yourself, hey, is 18% a year good enough for me? It lets you immediately stack that potential return up against your own personal investment goals. Use case number 2 is all about stress testing your big ideas. Let's say you're really bullish on a company like PDD Holdings. Well, instead of just hoping, you can use the edit mode to actually model it out. You can play with the growth rates and the exit multiples to see exactly what would need to happen for that stock to, for example, double in price. It turns your story into actual numbers. And this edit mode gives you total control. You can tweak your growth assumptions, the final multiple you think the market's going to pay for the stock, and even how many years out you want to project. Best of all, the results update instantly, so you can see in real time how sensitive your potential returns are to every single one of your assumptions. Another really smart thing the tool does is adapt to whatever market you're looking at. So for Indian stocks, all the numbers are in crores, and the default discount rate is set at 12% to reflect local market conditions. But if you switch to a US stock, everything automatically flips to millions of dollars and a 10% discount rate. It makes sure your baseline assumptions are always relevant. So let's just tie this all together. We started by figuring out the market's expectations using the reverse DCF. Then we used the earnings and OPM tabs to build our own scenarios and see what our thesis could mean for returns. And we saw how to pick the right tool for the job, depending on the company we're looking at. It's really a complete framework for forward-looking analysis. And that really just leaves us with one final thought to chew on. This isn't just about analyzing a single stock. It's about a whole new way of thinking. So I'll leave you with this question. Take a hard look at your own portfolio and ask yourself, what level of growth is it really priced for? So if you want to start answering that question for your own stocks, you can try this out yourself. All you have to do is install the Finmagine extension, head over to any stock page on screener.n or stockanalysis.com, and just click on the valuation tab to find the calculator.